The Federal Reserve is pausing rates for the first time in 15 months. You're talking about almost 2 years. Not exactly, a little bit over a year. But that's pretty.
I think a lot of people have got excited when they heard that he's pausing.
Because what does that say? That means
are we going to transition back into like that crazy bull run? Are they going to start pumping more liquidity into the market? What does that mean? Our houses, the interest rates are going to go back down, all that, cars. But after listening to it, it looks like they're just pausing
to see. Yeah, they just want to see, okay, we've been doing it for the last 15 months to see. But he did say that this pause doesn't mean that the rest of the year we're going to pause or lower. They're not going to lower. They're not going to continue pausing. They're actually going to still continue. So according to him, they're going to increase the rates 2 more times, and their next meeting is in July and so on, and then another one in September, and then towards the end of the year. But
he's also said that just because he's pausing doesn't mean he's going to start cutting rates. I think every time he does a speech, he says this high interest rate is going to be here longer than what people think or have been used to the last 10 years of kind of like this graph shows how interest rates were very low. I think what he wants to do is kind of keep it at this interest rate, especially because the stocks are going up. People are still employed. Nothing has really truly broken. Yes, banks have collapsed and all this stuff, but the average person is doing more than fine. So this interest rates being this high is actually showing that he can keep it at this level, if not raise it.
Yeah, because he would say, it's gonna cause pain. We're gonna have unemployment rise and all that, but nothing as employment. Supposedly right now, unemployment is the lowest it's ever been in years. Years.
Yeah. So it gives him more, like, okay, I can continue raising, if not keep it at this rate. He doesn't really have to lower it. Like how we talked about in a previous video, every time they would transition from raising to lowering is because something broke in the market, in the economy, jobs, recession, the housing or something that they had to switch. But if there's no reason that anything has broken to that extent, they're just going to keep it, if not raising.
Yeah, and obviously they're still, on high alert and trying to monitor the market to see, with recession and all that, of a potential recession, because obviously they're not going to raise the insurance during a recession. If anything, they'll lower it. So, I mean, what does that mean for you? You might be watching this and you're thinking, okay, what is the higher, what is the lower interest rates? Let's break it down real fast. So whenever they raise, let's take it back to the very beginning. A Federal Reserve Bank is the main bank of the United States. We'll say that. That is the bank of Chase, Wells Fargo. That's where banks get their money from. That's their bank.
They're the jefes.
So they lend out money to, Wells Fargo, Chase, Citibank, etc. Let's just say they loan out $100 to all those banks for 5% interest. Those banks now have to loan out money to us, the consumers, the people.
Businesses.
They're not going to, give that money out for 5% as well, because then they're not making any money. They have to loan it out for 7%, 8%. So whenever the main bank raises interest rates, that also raises the interest rates of the bank. So it raises everything gets more expensive. Car loans, home loans. But then, the other way around, savings accounts, like high yield savings accounts pay a lot more now. So there's some pros, there's some cons. So if you aren't in the market of buying a house, a car, then you're fine. But if you really need a car, you're going to get a high interest loan. It's even at credit unions, they're high everywhere.
The only thing is it's high for our standards the past 10 years, but it's actually not at a crazy level either.
No. Yeah, so it's definitely not crazy high compared to like how you're saying, like in the past year. So even though it might seem like, oh my God, they're raising interest rates again, home loans are at 7.5%, which it is high because prices are high as well. But we've seen in the past, you look at the graphs, that there's been a time, I was talking to my dad where 10%, 20%,
normal,
15% interest rates were normal. Yes, of course, the houses were 100,000, 50,000. So that's a huge factor as well. When you buy a house that's $1 million with 15% interest rate, it's a lot of money.
Yeah. I think more than anything, this shows that maybe the best thing you can do, unless you really need to, like you were saying, of buying a car or a home or whatever, is try to keep your expenses low, because at the end of the day, we're kind of like in this weird stage of the market, kind of like it shows every time they go up, we're at this point where could it go higher or we're just going to go down, and it kind of feels like that right now. It feels like, especially, on social media or on TV, finance channels, it all feels like we're back. Everything's good now. And we're going to go back into,
To the moon.
to the moon, which kind of feels weird because at the end of the day, we're still in this, we're going to start feeling the pain, especially those who have student loans in October when we have to pay that again. Is that going to affect the market a lot? I feel like it is, especially those who have a crazy high student loans. So we have gotten used to 3 years without paying that. I think there's still a lot left at the end of the year. We don't know what's going to happen. The market, housing, maybe unemployment could all change, credit cards through the roof, savings is at the lowest point. So I don't know. We're kind of like in this iffy stage of the market.
And maybe, you might be in an industry where you already are feeling the effects of unemployment, because in general, unemployment's low. But I have a lot of friends that just graduated with tech. That's computer science, software engineering. I know people that have had months, almost a year, they still can't find a job.
Really?
Yeah, like months, they still can't find a good paying job because they were used to, I just graduated college and I'm making $150,000 a year right out of college with bonuses and shares of the company. And other people, the jobs that they're offering now are like 40, 50, 60,000, which is normal for most college graduates. Their first job is that. That was my job, the first job. I wasn't making crazy money. But they're not. We're all of us. We're all spoiled. We're all spoiled. The market, the income, the salary, everything was just up to the moon. So we'll see what happens. But we just want to keep you guys informed. That's what we try to do here at the nonprofit, is bring you the most latest data and information for you. So at the end of the day, save that money, keep your expenses low, and comment down below what do you guys think will happen towards as we hit Q3 and Q4 of this year, 2023. And be sure to check out our other videos for more finance news.